Hey everybody, it's Dan Morey, and I'm excited to be talking to you about a topic that is usually not interesting, in my opinion, but necessary, very, very necessary. And I actually have somebody that I've been uh, sort of looking to as a business advisor in this industry for over a decade as it relates to insurance. And I have Kurt Murray, who's a principal with Assurance, that was the largest broker for insurance products for the staffing industry in the United States before they were acquired by Marsh McLennan, which now they're even larger, probably 4 times the size of even the next insurance broker out there. So they're the largest. They serve the most staffing agencies in the country, and they are, in my opinion, the most knowledgeable insurance advisors to help agencies navigate the very complex insurance marketplace, as well as the varying client requirements that come with insurance coverage for your agency. But we're going to talk about something today that's crazy. So, Kurt, first off, welcome to Staffing Monthly. I'm grateful that you're here and can share your time.
A pleasure to be here, Dan. I appreciate the invitation.
So you brought to our attention a few months ago now, but it really started heating up over the last few weeks, a major change that you're the only one that I've heard really mention it to us. And I feel like most agencies don't even know this happened. And it is the fact that Philadelphia, that writes 80% of the staffing industry, is no longer going to be offering the primary non-contributory endorsement for auto insurance. Is that right? Do I have that
That's
right?
exactly correct. And that change took effect on May 1st with all renewals.
So what does that mean? First off, what is this endorsement? I didn't even realize there was a difference between auto coverages. I thought the coverage was the coverage. So what does this endorsement actually cover? What does it mean? What are we losing?
Yep. Hey, is it okay, Dan, if I take a step back and explain the reasons why before we
Yeah,
explain what the impact was? Is that cool?
absolutely.
Okay.
Yeah.
So looking back at the insurance industry's profitability for the last half a decade, last 5 years, the industry as a whole has been losing money on auto liability for as long as I can remember. It's been at least 5 or 7 years. So the industry as a whole has been increasing rates and increasing deductibles to try to cover the losses. And the losses are really being generated by catastrophic claim settlements approved by the courts, right? Judges, either bench or jury or through mediation. The awards keep escalating and escalating. The largest one I'm aware of in the staffing industry actually occurred maybe 5 or 6 years ago. It was settled out at $27 million related to an auto accident for a salesperson for one of your staffing peers, and that was in Colorado. So that's a precursor. So something needed to change. So the industry is looking to make changes in order to limit their potential liability for future claims in order to right the ship regarding their profitability. So what Philadelphia has decided is that they are removing what's called the primary non-contributory wording from their auto liability policy. Specifically their hired and non-owned auto liability policy. The primary non-contributory endorsement affects the way coverage responds. So for the staffing industry, your policy is written as are all hired and non-owned auto policies written on an excess basis, meaning they respond secondarily to the primary coverage. However, your customer's coverage should be primary. However, your contracts that you're signing with your customers in many cases require you to provide your customer with primary non-contributory status on your hired and non-owned auto liability policy. The hired and non-owned auto liability policy covers one hired, which would mean your rental cars. So cars that you're renting on company business, but more importantly and more frequently becomes the issue, it's non-owned. So non-owned are your employees using their personal cars on company business, such as executives, salespeople going out to see customers, even your office staff, your internal staff running errands, running to the post office, going to pick up things, deliver checks, that sort of thing. But it also applies to your temp population, all your contractors, your professionals that are out in the field. If they happen to drive either on a assigned basis, drive a customer's vehicle, or sometimes what happens is unknowingly, your customer may ask them to hop in a customer-owned vehicle and go deliver a part, pick up something from the post office, or they're using, or the customer asks your temp to use their personal vehicle. on your customers related business. Now all of a sudden, your policy, because you've granted primary non-contributory status, your higher non-owned auto policy becomes primary over any other collectible insurance.
Oof.
So that becomes the issue. So in all of these claims that have been occurring where there's primary non-contributory, your policy responds first, right? Which should really not be the case for your temp population.
Right.
Um, it should be that since your customer controls the work site, your customer controls the employees, dictates to them what they do and what they don't do, unless you have an on-site. Take a little step back there. If you've got an on-site supervising, then that changes the scenario a bit. But your customer's the one driving what your employee does on a daily basis. If you're placing drivers, your customer controls the delivery routes, controls the time that the drivers are there, really is responsible for the maintenance of the vehicle. Because in many cases, we see that these accidents are related to improper maintenance of vehicles, brakes fail,
Yeah.
tires blow out, right? That sort of thing. So your policy is still responding, though, if you grant that primary non-contributory status. What Philadelphia has decided to do is remove the primary non-contributory effective May 1st from all renewals, and they are no longer offering that to any new business on any new business that they underwrite. So
Got
that's
it.
a market change. So what that causes for you as a staffing agency owner is you're now have dozens, potentially hundreds of contracts that you've signed with customers requiring primary non-contributory higher non-owned auto status. So coverage doesn't exist. So what do we do? Right? That becomes issue. How do we solve this
Yeah.
problem for you?
And that's why I wanted to have this conversation with you, because for us, even though you've been telling us this, we just treated it like a difference in renewal. Like we weren't actually thinking about, oh, we're going to have to go amend contracts. And sometimes that's easier said than done, because from my experience, most of the contracts that actually require that primary non-contributory, I guess, certification on the auto insurance are bigger clients, are the MSPs or larger corporations that have longer sales cycles, legal review, all of that kind of stuff that's going to be pushing back at that. So I wanted this almost a PSA for me at this point. So if you're an agency and you're just learning about this, you should really be thinking about go do an audit. I know that's what assurance you did. You looked at all of our agreements and called out it was amazing. Actually, you're right down to the paragraph. You're like, this is the sentence that you need to be aware of, and this is what needs to change. But agencies need to do that audit and see which clients do you have require this PNC, this primary non-contributory on the auto insurance, so you can start the conversation before your renewal. Because if you can't get these contracts amended before your renewal is done and you lose this, you're immediately out of compliance with that contract, that's not a good situation to be in with your clients.
100% correct. And what we did with you, and this is probably the quickest way to start this process, is ask the broker for a list of all certificate holders that evidence primary non-contributory wording on the auto. And then you narrow it down to whatever it is, 5, 8, 20, or in one particular case, I had a client with 797 certificates issued with evidencing primary non-contributory wording. So
hopefully their renewal is in April and they have the whole year to sort this out.
July 1st.
Oh,
Yes.
Yeah.
And what we feared, Dan, and you alluded to this a bit earlier, is that a lot of brokers don't even recognize that this change occurred. The insurance companies have to send notice of coverage term changes in most states, somewhere between 30 and 90 days. In most states, it's 60 days out. And we don't know this is happening currently, but we fear in a lot of cases that the brokers who don't understand staffing and don't understand the coverages are actually issuing certificates on renewal since May 1st that still show evidence of primary non-contributory coverage because they're not reading the policy forms, right? They're not analyzing the quotes from Philadelphia in enough detail to understand that existed. So what that does for the agency is it potentially puts you in breach of contract. So even though you are showing certificates of insurance to your customers that show that you have the coverage, so you're passing that certificate review, the MSPs have a large staff that check boxes and make sure the coverage exists. Sometimes your mid-sized customers have their own risk managers or attorneys review them. If the certificate says you have it, they're going to rely on the certificate. Now, in the event of a claim, and you go to file a claim and that coverage doesn't exist, the insurance company is going to deny the claim, and it's going to put you in breach of your agreement with your customer and make you as the agency
On the
liable for
hook.
the losses that result from it. And again, I know of a $27 million claim. I've personally had claims of in excess of $1 million in probably 7 cases over the last 10 years. Biggest one I've had is a driver of a semi hit a bridge and caused the bridge to nearly collapse, and the bridge had to be rebuilt, and it was an $8.5 million claim.
Was that what happened to I-95 earlier this year? Was that
Similar, yes.
over Philadelphia? I
It was
shouldn't laugh
similar.
about that, but
It's not funny.
it's so. But that's what I was going to ask, is if like this staffing agency, if they get it from their broker and they just like, okay, everything is right as rain, and then this happens, and the insurance company's like, we don't know why your broker, released that. Like, is there any recourse? Because I know the staffing agency is going to be like, the client's not going to pay, right? We know that.
Right.
So the staffing agency is on the hook. Is there any recourse? Can the agency go back to the broker and say, hey, you gave me this certificate? Like, what? How does that work? Like in that scenario?
Us issuing an accord is the form,
Yep.
certificate of insurance. There's a disclaimer on the bottom that says this is a representation of what your coverages are, but it's not a guarantee. So you could attempt that as an agency to pursue an E&O case against the broker. In some cases, there's a settlement. In some cases, it wins, but legally, we as an industry can be let off the hook by the courts because the accord certificate is evidence of coverage. It's not a guarantee that coverage exists.
Right.
And you don't want to get in a fight with your broker.
No, you definitely don't. And honestly, like if it goes to the courts is going to look to the agent. I mean, they're going to look to all the pockets that have money, but
Correct.
ultimately they're going to be squaring in on the agency because
Yep.
they're at the center of it all. So
Yeah, and in a lot of cases, $50,000, $20,000, $100,000 claims, the agency will probably write a check. But if you're talking about a multi-million dollar issue, it's going to go to the courts.
yeah, it will. I mean, because you got to roll the dice and see how good you can try to make it if you're the agency, because
Yep.
that's a worst case scenario as is. So May 1st, this took effect. So they're not writing it. But this is only Philadelphia. So like if you're an agency out there and you have big clients that are really important to your operation and you're like, I need this.
Mm-hmm.
You can go to, there's other insurers out there that will offer this endorsement. Yeah.
There are 2 other programs that are built for staffing. One of them is underwritten by Everest. One of them is underwritten by Markel.
Okay.
Both of those have much smaller market shares, and there's a reason why they carry much smaller market shares. Philadelphia had the broadest appetite. So Philadelphia would write construction, liability for construction. They would write medical, allied health, medical professional liability, errors and emissions coverage. They would underwrite driver placements. Markel and Everest do not have that broad of an appetite. Plus, those 2 also have their own coverage problems. So while Philadelphia had the broadest coverage up until this change, Everest still has an issue related to an absolute workers' comp exclusion, which puts you potentially with no coverage in the event that one of your employees is injured. File suit against your customer, and you've indemnified that customer against work-related injuries. If that suit gets tendered back to you, there's no coverage for that.
You're back on the hook again.
Yeah, you are. And for anybody in the allied health space, nurses, CNAs, RNs, LPNs, their appetite for underwriting that medical professional liability is much smaller than what Philadelphia's is. Philadelphia is much broader. Same thing with Markel. Markel won't even write medical professional liability. So anybody that's in the medical space, health space, is out. Anybody, and then Everest and Markel specifically exclude driver placements from their coverage form. So anybody that has a driver, even one, is precluded from potentially being underwritten by Markel and Everest. Wow. And they're typically more expensive. Both of those 2. Philadelphia was broadest coverage form, most price competitive, which is why they controlled 80% market share.
So that's another question, and I'll never forget. I had a client one time use this phrase on me: if I'm getting less service, shouldn't I pay less? So is there a chance that if this endorsement goes away and the P&C or primary non-contributory coverage is not there on auto, which was driving the most losses for the insurer, is there a chance that this coverage will actually flatten or go down or be less expensive in future renewals?
We don't think so, and here's the reason why. When we look at our own book of business with Philadelphia, and not to share numbers, actual hard premium amounts, but we're the largest broker in the country. The auto liability coverage is less than 10% of the total premium that our clients have paid to Philadelphia. When you look at their loss ratio on this auto policy that they write, it's about 140 to 160% based upon their numbers. So we think that their entire book of business, entire premium base, Philadelphia that is, for autos maybe in the 18 to $20 million range, which means that they're incurring losses of 20 something million, potentially $30 million, right, on the high end. But that's such a small percentage. It's only 10% of the total premium volume that's controlled by Philadelphia. So if it's $30 million for auto, if it's only 10% of the premium, then their total book of business for liability is, closer to 300 million. Maybe it's 400 million. So on a percentage basis, it's a really small amount of the total premium. So we don't think it's going to have that big of an impact. And then you break that down by 7,000 customers of theirs, roughly thereabouts, and you can see how small the average premium was for the auto liability. And it, typically this higher auto liability previously was costing a lot of agencies somewhere between $3,000 and $10,000. So it's a small portion of the premium paid, but it's a significant coverage problem that's been created.
That makes sense. All right. So, I mean, that was a super comprehensive deep dive on this, and I'm sure it's informative for the agencies out there. And you covered the key action item that everyone should be taking is doing an audit or asking their broker to assist with the audit to see where there might be compliance gaps. The final question that I have for you today, just because you provided this level of guidance to us, is do you have any guidance, words of advice to the agency about how they might approach their clients to sort of explain this situation to them?
Yeah, and we do, and that's a good point. So we provided talking points to all of our customers so that they can go back to their customers and talk about what the issues are and what the potential resolutions are. So we do recommend that if you're with Philadelphia, that you have your broker look at the program with Everest and the program with Markel, because they have to do the due diligence to get quotes. You can make a determination as to whether or not the coverage deficiencies that exist in the Markel and the Everest program versus the Philadelphia program are more important, more significant than the issues that the Philadelphia coverage restrictions now have created, and whether or not the premiums themselves make sense to you. So everybody has to make that individual decision.
Right.
But there are talking points. I mean, the agencies should talk about the losses in the industry. Agencies should talk to their customers about the fact that their customers are controlling the work environment, right? You don't have any control over what your temps do on a day-to-day basis, what they're told to do, how they're reassigned. We recommend you always put in your contracts that the customer will indemnify you for losses that arise out of your employees being assigned to specific job duties that you did not previously authorize. That'll help, right? Because if you're placing people in a manufacturing environment or distribution environment in non-driving roles, and all of a sudden they ask your temp to go drive, if that customer's indemnified you against those types of losses, then you have something to talk to them about, right? Obviously, you've got to make a business decision as whether or not you want to cover a claim. If you got a $50 million client, $10 million client, and it's a small claim, you're probably going to eat it, regardless of what the contract says. But yeah, there's got to be due diligence done on, for looking at multiple insurance companies. Have the conversations with your customers, talk about the issues that are being created in the industry due to the losses. Talk to your customers about the fact that they control the work environment. You're not placing drivers. If you're not placing drivers, tell them you're not placing drivers. You shouldn't be placing drivers, right? There's no associated liability from your temps being in a distribution facility or a warehouse or a manufacturing environment when there's no driving exposure. That should be able to be negotiated out of the contracts. The only time that we would expect that you would need to have some language in there is if there is incidental driving exposure for your temps. And in that case, we always recommend that the indemnification get completely switched. They indemnify you for losses that arise, and they make you additional insured on their general liability, and they give you primary non-contributory status on their auto liability policy because, again, you're not controlling it, they are. So that'd
Love
be
it.
my advice.
Love it. It's great advice. And I feel like I lied. And if we're up against time and you can't answer this one, it's okay. But it made me think about a whole other can of worms. How does this, because I know a subsect of this industry is serviced by PEOs
Mm-hmm.
or basically back office providers that provide the insurance for them.
Mm-hmm.
How do you think that's playing out? Because obviously they're getting insurance from the same marketplace. Do you think the agency that's a customer of the PEO, that's basically being the EOR and providing the workers' compensation, the auto insurance, all of that stuff, do you think that that agency is still going to end up on the hook, or is this something that the PEO is most likely managing?
You have opened up an entire new can of worms that I could probably talk for another 30 minutes about.
So let's do this. We'll do a part two. I will bring you back on because I want to be respectful of your time today. But that'll be a good teaser for it. But I would be really curious about how that one plays out because there's a lot of people that just outsource their back office to a PEO.
There are.
And I could see the fact that you have another middleman in this kind of chain of custody of insurance here that something could get missed.
Yeah, and EORs specifically cause a lot of coverage issues. PEOs not as much, but it is still a consideration in how your PEO contract is structured, your EOR contract especially, and who are party to customer contracts, because that all determines where the coverage would exist.
So that makes sense. So then for all of you that are in that camp where you're working with an EOR or a PEO, the first piece of advice still applies. Go look at your customer contracts, work with a broker, work with your PEO or EOR and say, hey, does this impact me? And find out which one of your clients have a contractual requirement of primary non-contributory for your auto insurance and see if this impacts you. Because if it does, you're going to be out of compliance shortly and you could potentially be on the hook for a massive claim if, God forbid, something happens. So, Kurt, thank you so much, man. I appreciate you coming on here and sharing your wisdom and just kind of being the voice of reason as you always are.